Good day. Today we are going to talk about IAS 37, provisions, contingent liabilities and contingent assets. The lecture structure for this specific video will be why there is a need for IAS 37, provisions, and more in detail the definition of provisions and the recognition criteria of the provisions. Then, why is there a need for IAS 37? For example, you as a company can have this situation on hand and you need to know how to account for this specific case. And another example is, for example, case number 2, and how do you account for it? Therefore, the need for IAS 37. And just in more detail, the framework requires that financial statements needs to be a true and fair presentations. The prudence concept requires that liabilities are not understated, and therefore IAS 37 gives us guidance on when you should only disclose and when you should recognize and disclose in the financial records. For example, the case example 1 and case example 2, how a company needs to account for these situations. Now, just another background. The provisions, just background. Provisions deals with uncertainty. The recognition of an item in the financial statements is the first prize. If it can't be recognized, it must be disclosed. In exceptional cases, we do nothing with it, meaning we don't recognize or disclose it. And then IAS 37 gives the necessary criteria for all of the above. Now we're going to look at provisions. What is provisions? The definition of a provision, very importantly, a provision is a liability of uncertain timing or amount. Remember, a liability is defined in the framework as a present obligation arising from a past event of which settlement of which is expected to result in an outflow of resources embodying economic benefits. The most important is a provision is a liability of uncertain timing or amount. And remember, a provision can only be recognized in the financial statements when it has met the definition and the recognition criteria of the provision. Therefore, the definition of a provision is a liability of uncertain timing or amount. Then it only needs to comply or meet the requirements of the recognition criteria, then it can be recognized. And what is the recognition criteria of the provision? The recognition criteria is an entity has a present obligation, legal or constructive, as a result of a past event. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. Then, when you recognize it, it will be a profit or loss or an asset item, and the provision will be credited. Now, looking at each of these, a present obligation is you have to take into account all the information, and it is more likely than not that a present obligation exists. An entity has no realistic alternative but to do so. An example is the legal advisors think that there is a 50% chance that ABC will lose the court case. There is a more than 50% chance, then you recognize a provision. If the legal advisors thinks there is a less than 50% chance that ABC will lose the court case, you recognize no provision because it's not more likely than not that a present obligation exists. And then a past event is a legal obligation enforced by law, or a constructive obligation, events that create valid expectations in other parties. What is a legal obligation? It is, for example, a cell phone contract or legislation, the law that law to restore the environment, or other operating of law. For example, when you think about when you did IAS 16, where you had dismantling cost, or when you had to restore the environment after the asset useful life, that is a provision that is recognized in terms of IAS 37, and it is a legal obligation because law required you to restore the environment. What is a constructive obligation? A constructive obligation is an obligation that arises from entities' actions where, by an established pattern of past practices, published policy, or sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. There is an expected outcome. Or you don't need to know their identities. So there is the customers expect something, you expect something from the entity because of their actions. For example, the past practices or the policies that they have. And as a result, the entity has created a valid expectation on the part of the other parties that it will discharge or fulfill those responsibilities. Then you only recognize obligations that are independent of an entity's future actions. It can't be changed by the entity's actions. Examples of this is SAA will replace the seats on the airplanes every 3 years, or employers of SAA dumped oil into a nearby lake. Legislation requires that any environmental damage should be repaired by the responsible party. That means it is in terms of legislation, an entity's actions can't change that they need to adhere to this legislations. And then the other part is probable outflow of resources embodying economic benefits. It's probable, so it is more likely than not that the event will take place. And then similar obligations may be aggregated. For example, outflow of one obligation may be small. For example, with a clothing store, each item will probably not be returned. Or you can consider it as a group where, with a clothing store, if you look at all the clothes, some will be returned. We will talk later about it. But so a store has a policy that the customers can bring back their clothes in a certain amount of time, and then they will get their money back. But it's not to say that each item will be returned, but some of the clothes might be returned, and therefore you group them together. And then remember, if it's probable, you recognize a provision. If it's not probable, you disclose a contingent liability. We will talk about it later. And then if it's remote, you do nothing. And then the opinion of legal advisors are a good indicator. Remember, for a provision, there needs to be probable outflow of resources embodying economic benefits. Then, just an example, allowance for credit losses. It's not a provision because a company does not have a liability. And it will be the adjustment to the impairment of the financial asset is in terms of IFRS 9 that you will only learn in third year accounting. And this means that you need to watch out for what you call provisions in the future. And allowance for credit losses is not a provision because it does not have a liability. The company does not have a present obligation towards the allowance for credit losses. And then just the last part, a reliable estimate. The use of estimates does not undermine the reliability of financial statements. Remember, even in IAS 16, you needed to make estimates of the residual life or something, but when it's wrong, it's not incorrect. So the use of estimate does not undermine the reliability of the financial statements. And remember, if a reliable estimate cannot be made, you can't recognize the provision, because the recognition criteria of a provision is that there needs to be a reliable estimate.